Bank. But very quickly, we are back under it. So gains on the Nifty Bank need to be tracked. Mid-cap index is up 0.6, so that's much better. And the small-cap index is up about 0.12% as well. The heat map should give you a snapshot view of how we are starting this morning, and then we'll take it from there. So very few names are down. Bulk of what we have on the wall, at least on the Nifty, is up and about in the green. 100 points on the Nifty. Surabhi.
I was just looking at numbers for NetWeb, considering it was doing so well in the pre-open. It's astounding performance, top line, bottom line margins, and that stock's, of course, starting out solid in positive territory. But anyway, Nifty, let's look at what's moving here. The banks are slightly lower. Kotak is down 3% as the pre-open was indicating. The dip on SBI is indeed getting bought. That's exactly what Sudarshan was telling us, that could be a good trade. ONGC is down 3.5%. There's a massive decline, 4% drop on crude oil prices this morning. That's weighing. So it's lower quite a bit. JSW Steel is still down about 1% lower. SBI is trying to cut its losses. L&T is 0.5% lower. But the rest of the market up and about. So let's look at the upside of the screen then. You have Shriram Finance in leadership position, 2% on that stock. Adani Ports is up about 2%. Asian Paints is up about 2% as we speak. In fact, some of the smaller paint companies like Berger, even Kansai Nerolac, they're managing a small bit of green as well as crude oil prices come off quite sharply. M&M is reporting numbers today. Ahead of numbers, stocks up about 1.5%. Eternal, Titan, some of the discretionary consumption plays are seeing some buying. ICICI Bank is looking quite okay. It's a good counterbalance to the fall on Kotak. And Reliance is chugging along quite nicely, 0.5% up. ITC is also adding some weight. HDFC Bank is well up about 0.8%. So it's actually a very well-balanced market. ICICI, HDFC Bank offsetting some of the decline on Kotak or say SBI and other heavyweights also packing in a punch. So not bad, Nigel.
Well, that's right. Just keep an eye out on Force Motors. They came out with their monthly numbers and the numbers look quite good. Keep in mind the stock was up close to 8 to 9% in Friday's trading session itself. But it's a bazooka move yet again. Force Motors is now up close to around 5%. So big move is what we're seeing out there. The focus on premiumization and the Urbania vehicle, that seems to be helping their case because realizations will be much better in comparison to the erstwhile Force Motor favorite that we used to see. So the Traveller, that is. Well, focusing on a couple of other names, V-Mart is down 6%. So quite a lot of selling we've seen out there. We're seeing Nuvama Wealth Management as well as down close to around 5%. Jindal Saw is another name that's down close to around 4%. Out there, the profitability, in fact, has come down a little bit. Even if you adjust it for it, it looks pretty much okay. 4% lower than what Philip was working with, and their order book has declined. So I think that's why the street is a little bit cautious on that name. But the stock of the morning has to be RR Cabel, bazooka move out there. NetWeb also, good move is what we're seeing out there. Prime Focus is another stock that's actually opened up in the green. We normally don't talk about that name, but it's up close to around 7%. So just highlighting that stock as well. And CDSL, taking it on the chin. That stock down 5%.
Speaking of stocks taking it on the chin, look at Utkarsh Small Finance Bank. It's, I think, a disaster on every single parameter, from margins to gross NPS. Gross NPS have gone from about 6% to 9% plus, and big pressure on margins as well. Stocks down 4%. That's Utkarsh Small Finance Bank.
All right, so lots of stuff going on, and I think we'll have a fair bit coming through in terms of the action. We got about 90 points on the Nifty. We got about 24,440. The news flash at the bottom of the screen, the Adani Group, and this is from Bloomberg, Adani Group officials will be meeting with the Trump administration to dismiss criminal charges in the US. That entire process, etc., which was going on. So that is what Bloomberg is reporting at this point in time. Harish Krishnan is co-CIO and head of equity at Aditya Birla Sun Life Mutual Fund. Harish, good to have you with us here. Good morning. Thanks very much for your time. What is your and your team's assessment on the earnings so far? It's a dichotomy, right? Macros, we find ourselves in very, very comfortable macro kind of situation, even given all the tariff noise, etc. I'm keeping the geopolitical stuff aside. Oil and the other usual stuff which kind of defines the quadrant of what we kind of look at macro with regards to India. But on the other hand, earnings are still quite disappointing. They were supposed to be pretty poor for the fourth quarter, and I think they're following the script. Where does it leave markets, Harish?
Good morning, Prashant. Right, so of the 150-odd companies that have reported earnings, among the top 500, we've seen about a 5 to 6% growth at their top lines and a similar kind of a quantum increase when it comes to their bottom line profits. Of course, one needs to keep it in context as to the big reset moves that we've seen over the course of the last 3, 4 months. Keep in mind that a lot of the slowdown in growth that was happening in India was a function of both significant fiscal consolidation that we had seen in FY25, as well as reasonable monetary tightening that had happened with slowing credit growth that had happened, about 6 months back. We've seen a significant pivot on both of these moves, with some amount of, fiscal spending coming back, courtesy the tax cuts that came through. Of course, we've subsequently seen, a reasonable amount of correction in crude oil, which again should buttress a significant amount of fiscal position. Possibly it can lead to greater spending down the line. But the big shift has happened on the monetary side, where there is definitely an urging of the credit institutions to get back to growth. Now, both of these levers typically take anywhere between 6 to 9 months to show up. And therefore, we're not really so worried from a market level point of view of the slack in earnings that we currently are witnessing. Possibly in under 6, 9 months, I would think the Diwali quarter, etc., we will be singing a very different tune when it comes to earnings. So I think the market and the way we are thinking about is to look at whether the delta change in that impulse is more likely to be positive going ahead. And to that mind, I think especially in a lot of domestic oriented sectors, we kind of believe that that's more likely to be the case as we get on to FY26 and possibly FY27.
Harish, hi, morning. So you're saying by Diwali, we'll be singing a very different earnings tune, like a more pleasant one. That's what you're saying, that the market is a little too bearish and earnings will pick up?
That's right. So, like we've discussed in the past, also we've got each of these two resets, which is one is as far as the fiscal impulse is concerned. Second is the monetary impulse. Third, and of course, there is also the currency angle. Typically, a depreciated currency typically leads to an earnings upgrade about 12, 18 months from there. Of course, we've seen a lot of the currency depreciation kind of claw back thanks to the dollar weakness in the last month or so. But still, that is still net positive for earnings. So I think a combination of these three, to our mind, will lead to a slightly higher earnings growth. Of course, we are not saying that, if it was a 6% earnings growth, it will become magically 20% earnings growth. But can there be a potential, say, 2 to 3% higher earnings growth than what is currently being penciled in? We would like to think that that's very much possible as we look at FY26 end and more importantly at FY27.
All right. Hi, Harish. Good morning. Good to see you, Ben. Harish, so going by what you're saying, bulk of the correction is already in the price. The worst could be behind for the Indian markets and things could look up from here. I hope I'm getting that correct.
We think so, Nigel. So, I mean, when we look at the numbers, right, the Indian market cap has seen a drawdown of about 28% in dollar terms. Now, if you run this analysis from 2001, generally the drawdowns typically peak or bottom out, however you want to look at it, at around anywhere between 30 to 35% in dollar terms. So that really seems to suggest that there's a reasonable amount of flush of that excessive valuations and fraud that was there, over the course of the last year or so, that's kind of got cleaned out. Another data point that may be of interest to the foreign allocators, because we've seen significant amount of foreign selling in those 6 months. If you were to look at India's share of the world GDP, that's currently tracking at about 3.75%. And in our assessment, over the course of the next decade or so, this 3.75% of the world GDP is anywhere likely to track between 6 to 8%. That's pure math. The fact that, on a nominal base, we're growing at a faster rate compared to the world economic activity. More importantly is India's share of the world market cap. That bottomed out at 3% in March of 2025. The key question that foreign allocators will start thinking about is, if in a decade from now, we're likely to see anywhere between 6 to 8% of world economic activity, is 3% of world market cap a good enough entry point to participate in that long runway? We certainly do think that that's a very good time frame for global capital allocators to come through, and which is why, in totality, we do think that the worst is likely behind. That doesn't mean that, the next month we're going to see another positive month, etc. But we are definitely thinking that, one needs to be constructive on markets and on Indian equities going ahead.
How do you talking about asset allocation, how have you all changed your allocation strategy? Say when we had gone into that, in a bit of a tizzy in the month of March, what was it at that point of time? Exposure to equities, currently what is it, and how do you see it moving ahead?
Sure. So if you look at our asset allocation products, let's take the Balance Advantage Fund. We were at about 38% in mid of October when, the carnage kind of started. As the correction happened and valuations became more attractive and the froth kind of died out, we went close to about 70% in mid of March. Currently, we are at about 68, 69%. So we're pretty much holding on to those levels, which we've seen in, mid-March. In terms of our asset allocation. Just in terms of context, this product broadly varies from 30% to 80%. That's the gauge of equity valuation. So we are close to the higher end at this point of time, given the reasonable attractiveness of Indian equities from a long-term point of view.
By the way, I just want to point out Kotak Mahindra Bank, worthy of a mention here, because stocks down 5%. And because of this downward draft, SBI is also down 1.5%. The upside or the counter that we were getting from HDFC Bank and ICICI Bank, suddenly it's not enough. The Bank Nifty slipped because of these two banks. 5% down on Kotak Mahindra Bank. And, just a revision here, Kotak's asset, or rather advances growth is about 13% year on year. And the market perhaps is feeling it's not enough. Even the quarter on quarter growth, perhaps not enough. Harish, comment on this. Growth concerns for lenders, given the fact that they've run up very nicely through April. What would you play here in large banks, and how valid are some of these growth concerns?
I think, the reaction of the results are more a function of the fact that they had run up quite well, going into these events. Many of these banks are up 20-25% year to date. And therefore, there is some kind of booking of those profits. Like I said, we do think that, the overall credit growth is likely to head higher as we look at over the course of the next year and two. We think that, the larger financiers are extremely well placed, primarily because they've got very good capital positions. The extent of competition which is there in the overall credit market has actually kind of come down quite significantly. A lot of fintechs, etc., were breathing down their necks. They're no longer there. Even a lot of smaller franchises, their access to capital markets is kind of starved at this point of time. So we think that the large banks definitely are in a very good position. Yes, we do think that India cannot do with just 4 banks or 5 banks. There needs to be a lot more credit institutions that need to thrive. And therefore, we are playing a barbell through a basket of the significantly undervalued private financiers, which are below book. So that's the other end of the basket that we are playing. But our core position is in our larger private sector banks, which, of course, today they've taken it on the chin. But I think, from a broader perspective, the trend that they've seen remains pretty much intact. And we do think that, the growth concerns are more a function of the past. And as we look at the year and beyond, we do think that growth will start inching upwards.
Absolutely. Harish, you're bullish, and you're bullish that earnings will pick up as well, right? Because we need that to happen. Otherwise, you kind of get into, very quickly, valuation problems. So earnings have to expand. What is your sense? I mean, by Diwali, as you said, things will look very different. So for 26 and beyond, what kind of earnings growth are you expecting, Nifty?
So again, just to kind of nuance it, it's not, like I said, we're not expecting a 20% earnings growth to come through anytime soon. It's still a muddle-through economy. Today, market is pricing in, a single-digit earnings growth kind of from a buy-side perspective. I'm not even getting into the consensus estimates. We do think that a 12-13% growth is quite possible as we look at the end of FY26, and that can further improve by 1% or so when we look at FY27. Of course, there are a lot of moving parts, notwithstanding the global part of it, which we haven't discussed. But even when we look at the global perspective, we do think that India is more favorably placed, even amidst the global wars. Of course, if there is going to be a complete uncertainty, a phase of uncertainty that's going to cripple decision making, then of course, we will see some kind of a pressure. But the way the markets have reacted, and again, I'm not talking about the Indian markets, I'm talking about the US markets, where, they've kind of recovered almost all the losses that they did post Liberation Day. It does seem to suggest that the market view is that, we will not be going through this prolonged phase of uncertainty beyond the next 3 to 6 months. If that really is the base case, we do feel very optimistic about earnings improving. Again, the trajectory and the rate of change is what we are talking about. We are not talking about a very significant magnitude of that delta change, but the rate of change is definitely, to our mind, looking to be far more positive as we end FY26 and as we get into FY27.
Harish, compliments to you. I think you are one of the most bullish voices that I've heard in the last several weeks. It really stands out. And that Diwali call we shall remember. We'll talk to you, of course, along the way and around Diwali as well. We really hope, for the sake of the markets and the economy, that what you're saying is really what comes through. Thank you for joining in. Have a great day. Thank you. All right, so let's get back to our corporate conversations. And the next management and the stock and the company on our radar is Bajaj Auto. The April sales came in slightly below street estimates. Domestic sales seem to be still under a little bit of pressure. Exports, however, continue to pick up. So let's discuss the demand environment. We have Mr. Rakesh Sharma, Executive Director at Bajaj Auto, joining in. Mr. Sharma, good morning, sir. Always a pleasure to have you on. So, I have to start with this, right? Because expectations are running tall. And it's been a tough last couple of months. Now, on the two-wheeler segment, I know three-wheeler sales picked up. But on the two-wheeler side, I think sales are down about 7% overall. Domestic sales were down a little more, a little over 10%. So what's happening in April? Is this pickup not coming through? What are the signs you're getting on the ground?
Good morning. Not last 2 months, but I would say post October, it's been a very choppy domestic motorcycles market. And if you recall, Q4 was almost -2 or -3% for the industry. And therefore, April, looking out for April was very important because it's also like a mini season in the north, which are the marriage markets, which, by the way, constitute almost about 45% of the industry, which is the marriage markets. And there has been a very smart growth over March in April. That is the metric we were looking out for. It's difficult to compare this April with the last one. It would be a flawed comparison because all the marriages last year in the north were, bunched in April. So April was a big spike. But this year, happily so, the marriages are evenly spread out over April-June period. So therefore, we were looking to understand the industry and to understand our relative performance in the industry. We were looking more at how April is behaving versus March rather than previous April. So both from an industry point of view, there has been a very good growth, which is very heartening because it shows directionally the industry could be getting back into some growth.
I take your point, sir, and absolutely no harm in looking at quarter to quarter, given that the base is different with the marriage season being different. But so slightly wider question, we've just seen the first month of this year. How confident are you about an overall recovery? So, monthly run rate should be back above, say, 4 lakh units. If April is the right litmus test, you just heard the analyst there, not the analyst actually, the stock investor over there from one of the mutual fund houses saying that he's penciling in big recovery by the time we're in Diwali. For your business, for two-wheelers, domestic specifically, what do you see ahead next few months?
Well, I didn't listen in to what was being said in particular, but I think there is, April is pointing towards recovery. And like I said, it would be erroneous to just look at 1 month, because that is the nature of the things right now. It was, when there is growth, it's wrong to extrapolate it, and vice versa. But I think the industry delivered a 5 to 6% growth over the last financial year. And our estimate is that it should continue to do so. However, it may not be evenly spread across all quarters. We feel that quarter one should be a growth once we complete the quarter. And the right time to really understand the industry would be more around June or so. But at this point of time, yes, it is looking like, basis April, that industry over the financial year should behave very similar to what it has done last year.
Just a word on specifically on individual models, on Pulsar, maybe even others. Were there any price cuts taken in April?
In fact, it was a mixed bag. There has been some inflation, so we've passed on some pricing, and some of the models we have adjusted the pricing, particularly at the entry-level Pulsars, etc. Once we've got all the inflation costs, OBD2 costs, etc., and looked at competition, we have sort of calibrated the pricing. So it's a mixed bag. Overall, there have been some price cuts and there have been some price increases in domestic motorcycles as well as exports.
Could you tell us on the Pulsar particularly, Mr. Sharma, has there been a cut?
I mean, Pulsar has 15 or more than 15 models. So there has been a price cut in some, and there has been price increase in some.
Okay, you want to talk about it?
Our sales is Pulsar, so it's a very, very wide spectrum.
So you want to talk about it on a blended basis? What was the pricing change?
I don't have that number readily in my mind, but these are very minor changes. They're within -2 to +2%.
Got it. Okay, all right. That would be a fair estimate. TVS in the earnings call, they spoke about the African market hitting rock bottom, and they're expecting growth from here on. Could you tell us what is the run rate you did in Nigeria, because that's a market that we normally talk about? Is there a recovery that we're seeing? How is the trend?
Well, this period in Africa, particularly Nigeria, is a low period after the highs of Christmas, and immediately post-Christmas, the market sort of goes in Jan, Feb, March, and then into a decline, and then it sort of picks up again, I think, in August, September. So our retails are at about 15 to 18,000 units per month in this period. I would say slightly below expectation, because we have sensed that the latest round of volatility caused by all the geopolitics as well as discussions on tariffs, etc., has dampened the sentiment a little bit from a currency point of view in Nigeria. You see, what happens is the currency appreciates also. It's almost a dollarized economy, so people start to hold back purchases, hoping that it'll become stronger and the prices will sort of steady. So there has been a little bit of uncertainty over the last couple of months. It is settling down now, and hopefully things should start picking up.
So, sir, to round it up, if we talk about, say, exports in this month, you did about 1.45 lakh units with a 4% growth. So if we talk about the near future, because I understand there's too many moving parts for long-term visibility, but let's say next 3-4 months, what should be a steady run rate on exports in terms of absolute units, and also the domestic two-wheeler segment?
Well, I think the exports will, this month is in particular, again, a base effect, which is there because, there is shipping adjustments, etc., depending on how actually the sailings occur. And it's not 4% in real terms. I would say that we should be clocking between 10 and 15% growth in the next 3-4 months horizon, like you say, and which is the growth which we've been clocking over the last few months, and we expect the same to continue. So we are talking about 160,000-170,000 units per month.
All right, Mr. Sharma, thanks a lot for stopping by and filling us in with your take on how the industry is panning out, as well as for Bajaj Auto. We look forward to having a chat with you as the month progresses. Let's focus on Godrej Properties. The numbers look pretty okay. The guidance to some analysts were a little softer than what was expected. To help us out with the numbers, we're joined by the MD and CEO, Mr. Gaurav Pandey. Hi, Mr. Pandey. Thanks a lot for joining in. Well, a pretty good set in Q4, but you have guided for deliveries as well as business development to be significantly lower in FY26. What's the reason for this execution slowdown?
I mean, not really slow down, because if you go take a step back, right, we gave a guidance of 27,000 crores of sale for FY25. And when we're looking from a guidance perspective of this year, we wanted to do a 20% growth on the previous guidance, which meant we would like to guide the market at 32,500 crores of sales. And we did about 29,444 crores this year, which is the highest sales by any residential developer ever. And the idea was very simple, that, we like to be always be very confident of our guidance and beat the guidance. If you see our track record, we always exceeded our guidance. So this is a number we want to really hold ourselves to. And from a collection metric, actually is even more stronger, because a lot of this business, the value gets created not just from sales, but how are you unlocking that value through great asset management, leading to great collections. So if you see our collections, previous financial year, which is FY25, was about 70,000 crores, which is like massive growth over the previous high base, so like a 49% growth. In fact, our operating cash flows were like close to 7,500 crores, like a 73% Y-on-Y growth. And in spite of such a high base, we're looking forward to delivering 21,000 crores of collections over an actuals of 70,000 crores of last year. So I think the idea is to be very aggressive on our growth. And from a deliveries point of view, which is basically projects that will get into actual deliveries, we were able to bring some Q1 projects into previous financial year from an OC point of view. So against a guidance of 15 million square feet for last year, we did about 18.4, and some of which was preponement of these. And second was last financial year was also seeing a very high base effect of commercial, because we have a commercial portfolio. We saw almost 4.3 million square feet of commercial portfolio getting into occupancy certificates last year. And this is more of a one-time event which happens once in a few years, where you have suddenly a lot of OCs coming in. So yeah, again, in spite of such a high base, we're still looking at adding 10 million more square feet of deliveries next year.
All right, Mr. Pandey, let's get further into that detail then. Even if you take into consideration the fact that deliveries have exceeded FY25 guidance of around 15 million square feet by approximately 3.5 million square feet, there is still a decline of around 50% in the guidance what you're giving for FY26. What is the reason?
Finally, projects from a delivery happen because of the sales you've done 4-5 years back, right? Because you'd sell today, and because real estate is a place where you have to build tall story buildings, you have to get a lot of amenities ready. It's a 4 to 5 years and sometimes 3 years kind of a average cycle that you get to see. So the sales that you're seeing of last 2-3 years, that dramatic delivery you'll see in next 2 to 3 years onward, right? Whereas the deliveries you're seeing today is emanating from the sales done earlier, right? So each year we're trying to prepone. So try and see from a scale point of view, about 2-3 years back, our actual delivery was about 6.6 million square feet. So if you study our data, we were doing about 5,000 crores worth of sale and grew to about 7,850 crores. This is from FY18, 5,000 crore sales. We grew to about 7,850 crores by FY22. And then the exponential growth started, where the next year we did about 12,200 crores, then 22,500 crores, and this year 29,400 crores, right? But this exponential growth in deliveries will happen, like I was mentioning, 3 to 5 years from when the sales happen. Whereas from an actual OC delivery, we were doing about 6.6 million square feet, give or take 2-3 years back. Last year, we did about 12.5 million square feet, which was a huge, massive jump. Then we did about 18.4. So you can imagine there's a lot of execution efficiency, which has brought preponement of OC year by year. And then there'll be a lag of maybe a year or so when again the OC jump will happen.
Now, I take that point. Gaurav, you've guided for bookings growth of about 10% year on year for FY26. But last 3 years, we've seen significantly higher growth rates. And I think that was what we were trying to understand earlier as well, between 31 to 84%. So once again, I mean, what is the reason for the subdued guidance, if you can be specific. Are we seeing a bit of a slowdown in the overall sales as well?
Not on the contrary. I mean, if you see our Q2 and Q3 sale, they were about 5,000 plus crores. Our quarter four was a record 10,000 plus crores, the best ever number we've ever done. And if you see, in spite of very high base of 22,000 plus crores in the FY24 cycle, we registered a 31% growth in last financial year, which is 29,444 crores. Our volume growth itself is been like 29% and 25.7 plus million square feet of volume that we've delivered. In fact, we were selling like 42 homes each day. You know, that's the kind of scale we're achieving. Now, when you give guidance, right? I mean, what is the way you build upon guidance? So try and see our numbers from some context. We've grown about like 55% CAGR in the last 3 odd years, right? And when you have a very high base effect, you want to be very watchful that you guide the market in a way where you definitely deliver that and you tend to surpass that, right? On a very high base effect of growing so rapidly. So I think it's largely emanating from that perspective. It's not at all coming from a market risk perspective. I do feel there is an upside risk to that. And, the heartening thing for us, what we're looking from growth point of view is a slightly different strategy. If you see our numbers in FY20, we are under our economic interest in our projects used to be about 41%. And the economic interest in our projects last year is about 93%. The sales attributable to our P&L has grown by 11x in 5 years. So our focus a lot is going to be on execution and getting those into deliveries and accounting profit of the logged in profit and maintaining a very strong growth, which is about 20% on the FY25 guidance. So FY25 guidance was 27,000 crores. And we want to deliver a 20% on from a guidance to guidance perspective or 32,500 crores. But yes, you are right. It's a 10% over a last year number. So I do feel we will have a good shot of kind of beating it. But like I said, we are a sort of an institution which has always over delivered over what we say and do. And I'm very excited that with the kind of quarter four and the head start we're seeing in this quarter, there's no reason why we can't do better. But again, like I said, I just want to mention that we would like to guide the market on a sort of a more or less short number.
Okay, so let's talk about the expectations for FY26 in terms of the collections. How much of your collections will come in from existing bookings? How much would be from perhaps new bookings?
I mean, largely, we're looking at a growth from 17,000 crores to 21,000 crores worth of collections. If you just look at from a perspective, we did close to 7,000 crores of collections in quarter four, and preponement of a lot of these milestones of deliveries helped us getting it. I think collection as a metric moves, basis the quality of sale you do than any other metric. So I think our quality of sale is very, very high. And because of that, we're very confident that we should be able to meet and exceed, hopefully, the guidance of 21,000 crores. And this, just to give an idea, a fun fact is the kind of collections we did, to the best of my memory, maybe there will be only 2 developers who do sales more than that in the last financial year. So the guidance we're trying to give you from a collections is for 99% of Indian real estate, sales don't happen at that particular sort of a number. So yeah, it's a very strong number and we're gunning towards achieving that.
We take that on board, Mr. Pandey, and we congratulate you on that feat as well. Well done to you as well as the team. But let's focus on another couple of aspects. How much of the land acquisition did you do in FY25? And how much are you planning to do in FY26? How much of this will be new land acquisition in comparison to joint development? Give us some clarity.
I mean, we did about close to 14 transactions last year. We in fact bought 3 land parcels in auction in Kharagar. Otherwise, if I count them into 16, but consolidating them into one project is 14 land parcels and logged in about 26,450 crores of revenue potential through that. And we've, mostly we like to have very conservative guidance for business development because this is one metric we don't like to put, like a pressure on us that we have to acquire this much. But there is no reason we can't easily exceed that, because of the opportunities. These are binary number. But yes, we've given a sort of a very conservative guidance of 20,000 crores of business development that we want to do. But yeah, I mean, this has an upside risk, but this is not one metric we lose sleep over. We have to buy land parcels at the right valuation, at the right time in the right micro markets. But yeah, fair to say we have enough and more pipeline to meet this guidance.
Okay, Gaurav, finally, your cash flows have grown significantly. I think you're at about 7,400 crores as of the end of last year. What is the utilization and, how's the position looking from a cash perspective?
I mean, this is the number which is a derivative of your cost of construction and collections. We really don't give a guidance on operating cash flow. But yes, like I was mentioning, we have a very healthy visibility of collections. We will be increasing collections of 17,000 crores to 21,000 crores. So yeah, I feel we will continue to hit very good operating cash flows in this year and the years to come, because we've now got a vicious circle of good project churn and high quality of sales.
All right. Okay, Gaurav, we'll leave it on that note. Thank you very much for joining in and good luck for the rest of the year. We have to take a very quick break right now, but we'll come back on the other side. Markets holding up 0.5% of the Nifty. Midcaps doing very well. We will be in conversation with the management of RR Kabel and talk about their performance in Q4.
Okay, welcome back. We have RR Kabel with us. Stocks up 13% as we speak on the back of strong performance for the fourth quarter. We have Rajesh Jain, Chief Financial Officer of the company, joining us. Mr. Jain, good morning. Good to have you back on the program. Could you talk to us about the quarter gone by? Because if you actually look at what you've done in terms of growth and volumes, it is below what you actually yourself guided for. But I guess what the market is taking heart from is that you've done much better than some of your peers, especially players like Havells, etc. Both on the top line front, there is a big sort of beat. If I look at fourth quarter for you and fourth quarter for them, both wires and cables. Margins also have come up from on a quarter-on-quarter basis from about 7 to 10% for you. Could you run us through what were the drivers for this?
Good morning, and thanks for me having on your channel. This was our best quarter and best year in our history, and this we could achieve through growth in volumes and margin improvement also, and product mix also. This was like we have seen a very good demand in domestic as well as export market also, and wire, which is our core segment, there also we have seen good uplift.
Yeah, but sir, the point is that absolutely, and we should pull up a one-year chart of RR Kabel, and today's stock price reaction is a study in how positioning is very important for the market. Can we get a one-year chart on RR Kabel, please? The stock, when the market correction started in October, used to be a 1,700 rupee stock. Today, we're talking 1,100. And then from muted expectations comes in this performance, which is blowing past those expectations. So, sir, the point is that, yes, your wires and cables margin has come to 9%. Your EBIT losses for your FMEG business, they're also reducing. But can you give us some further guidance? Wire and cables, what is the growth rate you're expecting in that business this year? And on this FMEG losses as well, do you see a break-even possibility maybe in some quarters down the line?
Yes, so we have come up with Project Rise, which is having 3 years, like our vision, how we'll grow in our wire and cable business and FMEG business. And there we are expecting to grow at 18% in wire and cable and 25% growth in FMEG. On margin front also, we are expecting to improve and want to see double-digit margins 2 to 3 years down the line. And in FMEG, like of course, this year we will have positive break-even.
Sir, can we get slightly more near-term? I know that's a big rise plan. That's your 3-year perspective. You're really, putting a lot of capex to work as well. But can we get some more visibility? Let's talk FY26. What is the improvement in margins that you can look at for wires and cables? You're at about 10% right now. So by the end of 12 months, where do you want to be? And for FMEG, that EBIT loss, will it completely get wiped out this year?
Yes, this year we will have a positive EBIT in our FMEG business. And even in wire and cable, like when we are targeting, say, 300 basis improvement in 3 years, it means like year on year, we are targeting 100%, 100 basis improvement year on year in wire and cable business.
All right. Mr. Jain, just to clear the air, on your wire and cables business, the EBIT margin has come in at the highest you have seen since Q3 FY23 at around 9.9%. You're saying you can hold on to this 10% EBIT margins for cables and wires for the coming year. Did we get that correct?
No, not like that. Like last year, we had EBIT margins in wire and cable around 7.4%. And
Yes.
this year, we are targeting to have it between 8 to 8.5%.
Got it. So that clears out the air because I was just looking at a trend. And the last quarter, when I welcomed you, I said that it was the lowest margin in multiple quarters. This time around, it's the highest in multiple quarters, but you cleared the air 8 to around 8.5%. Yes. FMEG, you had told us that Q1 FY26, you're looking at breaking even in FMEG. Is that possible? The coming quarter, you turn positive?
Yeah, so we are quite near to that, maybe from slightly negative to positive. We are targeting almost it will be near break even in this quarter.
Near break even, but for the first half of the year, definitely it will break even, correct?
Yes, sure.
Got it. Okay, that's out of the way. You have a couple of challenges, Mr. Jain, and I like your optimism actually, because you have a new player that's lurking in the offing. The Birlas are eyeing the space, but as you told us last time around, the industry is big enough to take on, a new player. But you've also laid out some capex plans. So give us a few details on the capex plan first. What kind of an asset turn can we look at, a margin profile, and how do you fund this expansion? Go ahead, sir.
Yeah, so we are coming with expansion at our Silvassa and Waghodia facilities, and this will be majorly focused on cable. So we are expecting to have a asset turn of around 3.5 times. And since this will be we are very small player in cable, and this will increase our cable capacity to great extent, and we'll have higher growth in our cable business. This will be majorly funded through internal accruals, and there may be some short-term requirement of term loan for this asset or expansion.
Mr. Jain, just to come back to the margin picture for a cable and wire company, right? I mean, I'm assuming it's all about copper prices, isn't it? More for wires than for cables. So wouldn't it entirely, almost 90-95% depend on the price of copper?
Not exactly for that. Yeah, of course, it has a huge impact on our profitability. And as you have seen in last quarter itself, we were more than 9.5%. But to some extent, it is majorly related with our volumes also. Once if we have greater volumes, then our margins will be always on better side. So of course, it has some impact, but we have capability to pass on this impact to our consumers also with some impact.
Correct. So volume. So I think, as you said, volume is what we should focus on really, because the value is really, about the price of the metal. So what should we expect? Volume growth in FY26?
It will be around 18%.
18% volume growth.
Yes.
Okay. Your guidance for 25 was 15%, right? You ended with about 7.5%, right?
Yes. So last year it was around 10% volume growth.
But that is FY25.
Yes.
And you're saying now it'll be 80. You're targeting 18%.
Yeah. So since we are adding some capacity in our cable also, and this will be operational in this year, so that's why it seems achievable.
Sir, talking about the capex, I believe your capex for the Waghodia facility is about 1,050 crores, and then your capex at Silvassa, I think, is about 400 crores. What's the total capex? Can you give us a number?
Yeah, these numbers are correct, but in this Silvassa capex, our 250 crore is impact of previous capex also, which is going to complete it in this year. So net capex, new capex is around 1,200 crores, and 250 is carry on effect of previous. Yeah.
Got it. So new capex of 1,200 crore. How much is coming in from internal accruals? How much will you have to borrow? And just give us an update on the balance sheet position then. How much cash will you be left with, if at all? Will debt equity go up to what level? Just an idea for the capex.
So overall, even if you see our current leverage is very good, and our debt ratio is at optimum level, and right now we do not have any like term debt, and it seems that out of this 1,200 crores, we may require a term loan of around 200 to 300 crores. And it also depends. If we have higher accruals, then it may reduce also.
All right, Mr. Jain, you have a fair bit of your mix comes in from exports, a fourth of your business. Could you help us out with how do you see traction out there? Is there, some resistance from your buyers? And how much of your, as a percentage of exports or as a percentage of your total pie, how much goes to the United States? Because President Trump, is on a roll with all these tariffs. How much do you all export there?
Yes, so like almost 26% of revenue is coming from our export, and within that also like almost 10% of my overall revenue is coming from US. Sorry, of export revenue is coming from US. So it will not have that much impact. Yeah, of course there is still uncertainty, but what we think we are on like positive side. India is on positive side, and even if there are some decisions, India will be in beneficial position. Apart from that, also since we are now making a big expansion in cable, and we have seen a very good traction in demand from our export market also. So we see a very positive growth on even in coming year.
Okay, so no big signs of slowdown as of now is what you're telling us, and you believe India will ultimately come on top, and in that sense, RR Cable as well will do well, correct?
Sure, yes, definitely.
The timing of this capex coming on is the same time that the Birlas are going to come on with their capex as well. Both of them come on stream, I think, at the similar time. Your outlook as well as theirs. How sure are you on terms of demand? Do you think it'll be a bit of a problem, or do you think you have got this covered?
No, it is a very good scenario in the India market, also in international markets. And as I explained in our previous meeting also, that we don't see any issue in growth of India, and particularly in wire and cable industry, and there is enough scope for everyone to grow. And since this capex was already planned, and we are firm on this with looking to the market scenario, and it is going to be a very good achievement.
All right, Mr. Jain, I remember the last time around you said you're not too perturbed. The stock, though, had seen a sharp correction. Your numbers are speaking, though, and they look good. And your confidence about the year ahead as well is quite good. The last year, though, volume guidance, what you gave and what you achieved, there was a bit of a gap. This year, we wish you well, and we'll hold you to all of these numbers. Thanks a lot for joining in, Mr. Jain, and filling us in with that. That's the management of RR Cable. They're guiding for 18% volume growth. On the EBIT front for the wires and cables business, they're talking about 8 to around 8.5%. And the FMEG business that's been delivering losses, they say that'll turn around. And in fact, that'll deliver a positive number as well. Let's get in Mitesh Thakkar back on the show. Hi, Mitesh. Good to see you in as always. 10 a.m. and the Nifty bank that was showing weakness for around 30 minutes or so, that's almost moved into the green. So that buy on dip has worked out there. The Nifty as well up 150 points. Is today the day we go ahead and conquer the 24,500 mark?
Morning, Nigel. I think that's a real possibility. And, the idea was that last few days we were quite overbought on the Nifty hourly and 2-hourly charts. And that's why, we were seeing supply and profit booking at higher levels. It could still happen, but I think given the fact that there has been some cool off on Friday, I think the odds are that we could possibly, get past and close about 24,500. Once that happens, 24,750, 800 is the next area to look at.
Okay, all right, got that. And individual stocks?
I have a buy on Ramco Cement. Keep a stop below 940 here. Look for targets of 995. And Polycab is the other one. We were just talking about RR cables. I think Polycab also has given some kind of a price and volume breakout on the intraday charts. So buy here with the stop below levels of 55.90. Look for a target of around 5,800.
Okay, what about Trent? Trent is up close to 3.5%. The stock has been all over the place. Mangalam has been doing a lot of fundamental analysis. And various brokerages have, conflicting views out there. Today, it's moving up on decent volumes, 3.5% higher. Your view on Trent?
In the short term, Nigel, I'm positive. I think the stock has made a bottom around this 4,600 mark. And, since the 21st of April, it's turned sideways between 5,400 to about 5,100. A close above 5,400 should open the way for about 57, 5,800. I'm not sure of a long-term reversal, but in the short term, I'm positive.
Right. Mitesh, thank you very much for that. HP, by the way, HPCL is the biggest volume-led gainer on the NSE right now. It's got about 5% in gains. So it's finally coming through. And we should have IOC and BP as well, and take a look at what's happening with the oil marketing pack. So doing very, very well. And lots of other names with volumes moving around. We'll get to some of those in a bit. We'll take a break. We're back. More stock-specific action on the other side.
Welcome back. Let's focus on some interesting stocks. One of them that's finding a fair amount of green this morning is Marico. That's become a little rare when it comes to FMCG companies. Let's find out what's happening here. Mangalam, volume growth, I think 7%, right? I mean, it's FMCG companies, 7% volume growth. It sounds phenomenal in one sentence.
It sounds phenomenal in one sentence. Revenue growth beating expectations, volume growth beating expectations. And that's exactly the kind of environment that we're currently in. You know, growth has been so anemic that people are willing to discount a slight miss on margins for a 7% volume growth. And all the numbers that have been reported so far, 7% volume growth is definitely the top quartile for Marico itself. And that's what the street is rewarding. So revenue at 2730 crores, mildly above street expectations, 7% volume growth, above street expectations of 5 to 6%. And the EBITDA at an absolute level is largely in line. But because revenue growth has surpassed street expectations, because the numerator is, the denominator is a lot higher, we have the margins at 16.8% below street expectations, but no worries on the bottom line as well. 345 crores versus our poll of 335 crores itself. What's good is that, the outlook is even better. They maintain their double-digit revenue growth momentum target with double-digit operating profit target in FY26 as well, and they expect margins to expand in the second half of this year. over and above all of this, the biggest reason why the margins did come off over the last year was because of the rising commodity prices. And the company is looking to diversify away from the commoditized business. That's something that it's been doing. And now they expect share of foods and premium personal care in India to cross 25% by FY27. And this business, remember, is 300 basis points higher on gross margin as compared to the other parts of the portfolio. So things looking good, revenue growth coming by, margins expected to improve, and structurally as well, the company looking to diversify away from commoditized business has the street excited, and the stock up 4%.
Okay, all right. Nice and green on Marico. Thanks for that, Mangalam. Something that's not too nice and green is CDSL stock. It started about 2%, 2 to 3% lower. Let's see where it is right now. We've got Vamakshi joining in. CDSL, I think, is still slightly lower. Vamakshi, so what happened here? When overall slowdown and a miss?
Well, absolutely, Sudhmi. Quarter on quarter, definitely all the capital market players were expected to report a sequential downtake. But, for CDSL, it's a miss as far as revenue is concerned. Even it's a miss on the operational profitability as well. When you look at the revenue, that has dipped by almost 19% quarter on quarter. Keep in mind, the margins have come under a fair bit of pressure, down nearly 900 basis points to 48.7%. And this is largely being driven by an uptick in the computer tech expenses. The computer tech expenses have expanded by almost 14% sequentially. The net profit too, despite the sharp jump that we saw in the other income, has seen a dip of almost 23% quarter on quarter. Now let's look at how the company's segments performed. Depository activity saw a downtick of almost 18%. Data entry and storage saw a very sharp knock, down nearly 25% sequentially. But on the flip side, when you look at the repository business, that was up nearly 15% sequentially. As far as margins are concerned, it's a downtick across the board, with the hardest hit coming in on the depository activity, down nearly 1,000 basis points. Data entry and storage as well, down nearly 900 basis points. Operational metrics too were rather weak. CDSL net account opened were down nearly 30%. Demat custody also saw a downtick of almost 5% sequentially. So overall, not a great set for CDSL.
All right, Vamakshi, thank you very much for that. So stock's down about, almost 4% right now. NetWeb is going the other way, and sharply so. Again, a bombed out name. Vinny is here with details of the numbers. Vinny, over to you.
Hi, good morning. So in terms of numbers for NetWeb, a strong set of numbers that came in Q4 FY25 from the company. They met the full year guidance. What they'd spoken about achieving the revenue of around 10,000 crores, that is what they've achieved. It's about that. Profits of more than 100 crores, that is also what they have achieved as well. So yes, interesting numbers that have come in from the company in overall FY25 as well. Order book, when you look at it, sequentially, yes, there's a dip in order book. Mainly, there's a higher conversion rate is what analysts are highlighting. So because of that, there's a dip in order book sequentially. But overall, year-on-year basis, order book momentum has continued. They expect that to continue going forward as well. For FY25, the interesting trend that was there is that AI segment for the company that has done well. Now it contributes around 15% of their revenue versus around 11% that was there in FY24. Analysts also highlight that margins, a slight bit of a miss is coming in versus what their estimates were. So keep an eye out on that. But order book was healthy, strong performance in terms of revenues. Con call highlights what is what we'll await. That is happening today post-market hours. So key details will come out on that front as well.
Okay, all right, got that. Thanks very much for that, Vinny. We'll take a quick break on that note. Come back on the other side, and Lada will be analyzing the Q4 results of SBI versus the top 4 banks with Santanu Chakrabarti of BNP Paribas.
Welcome back. We are sticking with results. Two big banks, State Bank and Kotak Mahindra Bank, reported numbers and they are trading in the red right now. SBI's numbers were actually above street expectation. I mean, the profit higher by a good 3 to 4%. But the bank actually lowered its credit growth guidance. And that perhaps is responsible for the red. On the other hand, Kotak's profit itself was a tad below street estimates, but Kotak Bank importantly managed to hold its margins close to 5%. Now that most of the big banks have already announced their numbers, we thought that we can take a look at the overall picture with Shantanu Chakrabarti, the banking expert from BNP Paribas. Good morning, Shantanu. Thank you very much indeed for your time. First up, let's take a look at State Bank itself. It seems like good profit that NARCL's money has come in and maintained their margins quarter on quarter. You impressed?
I think the operating numbers from State Bank were fairly robust. I mean, there was a small negative surprise on operating costs. But the trouble with something like State Bank is because the fourth quarter, especially on employee gratuities and things like that, it becomes a little unpredictable. Their fourth quarter typically on operating costs. So we'll have to see how much of the increases are sustainable and how much is not. But broadly, on most operating parameters, it was a satisfactory set of numbers, if not exceptional. And one thing you have to keep in mind was that quite unlike Axis Bank, that NARCL release that you're talking about, the SRs, they have taken that to the other income line. I mean, you might have had a lower other income and a lower credit cost with the same profit outcome if they wanted. I think you absolutely nailed it, that the minor disappointment that the market is seeing relates to the fact that they guided for 12 to 13% kind of growth.
Yeah. Can we talk margins and treasury income a bit? How will margins pan out? Because the expectation now is that the end repo rate is either 5.5 or even 5.25. The possibility of RBI supporting a little more because inflation is coming in lower than expected. Then what happens to their margins? Contrary-wise, they should make money on treasury, isn't it, since yields are going down?
Right. If indeed rates come off in an accelerated manner and even the movement in the rupee remains supportive of that fact, the fact that growth has softened in the US market means that the odds of a rate cut there also now become significantly more pronounced. Absolutely on board with that macro view that it might be slightly more accelerated now. But we have to keep in mind, Lata, is that would probably mean that in the first half of the next financial year for all banks, earnings may see a small revision downwards, but you're going to get a concurrent expansion in margins and therefore possible potential upgrades Q4 of this financial onwards and definitely moving into 27. So it really
expecting earnings upgrades based on better margins
on the second half or at least the last quarter.
Okay.
Because
would you worry about loan growth generally, Shantanu? But SBI clearly indicated that people are deleveraging, large guys are deleveraging, and therefore there can be a loan growth issue. But overall as well, growth could take a bit of a beating because of this uncertainty that the tariff picture has put in. Are you all changing the loan growth picture for banking as a whole?
As of now, no. And I'll tell you why, Lata. Because, we have a run with a 13% kind of system credit growth number. And obviously, most of the better private banks are somewhere above that. HDFC is an exception for reasons that that matches more or less what the system is delivering. And why I'm not changing this is because our prognosis around corporate loan growth was always pretty muted. We are basing this on some normalization in retail growth and the fact that SMEs continue to run at a very robust pace, which we expect will continue. Now, as far as tariff impact is concerned, yes, of course, economic uncertainties and overall slowdown has an impact on credit growth. But we have to keep in mind that the primary impact on the banking sector from tariffs, if I forget the second order effects around GDP growth itself, is going to be from capital inflows. And there, the foreign buyer at the margin seems to have turned positive. And the consequence liquidity implications of that for the system are also now visible for all to see.
Yes.
So in that environment, I don't expect credit growth, expectations to shift downwards too much.
Okay.
See, 12 to 13, maybe, it is actually system growth. And for SBI to grow that isn't exactly a big change in view. Maybe it's a change in perception from what has happened in the last 1.5 years.
Okay. No, fair enough. Actually, my guess could be entirely wrong, and we could be a China +1 option, and credit growth may pick up as well. At the moment, too many moving parts. But Kotak Mahindra Bank, your summary argument is that they just have to show growth or they are too capitalized. Can you just elaborate, explain that point of view?
Every time I tell anyone a bank is too well capitalized, especially to a European or American investor, they look at me like I'm from another planet. Like, what is that thing that you're talking about? But the point is you're putting, multiple on capital at the end of the day. And that's how you're valuing the bank. So it's not just about the robustness of the bank. You're not buying bonds of the bank. You're buying its equity. And high capital has two impacts. One is obviously it overstates ROAs a little bit. More importantly, your ROEs become limited by the fact that, there's too much capitalization. So the leverage number is low. Or if you want to take an earnings growth prism on it, what happens is as the bank levers up, all other things remaining equal, earnings growth actually trails what loans grow at. Because with every passing year, for the same spread also, your net interest margin and ROA will optically look lower. Because a NIM calculation costs equity at zero, right? So as the equity proportion goes down, your earnings growth actually trails what loan growth looks like. And that's the problem around Kotak. So it's not, first of all, you have to understand that there's much that we like within the business, and embargo removal, etc., have to be kept in mind when we gauge its, loan growth guidance and these things. And there's nothing fundamentally wrong with it. Trouble is the amount of capital and therefore the multiple that you're paying on it. And relative to where we see our upsides in the other large banks in HDFC, ICICI, Axis, this has remained underperform. On the specific issue that we had mentioned, we had expected, effectively they're talking about 15-16% kind of loan growth, right? Which is robust, right? 300 basis points above system, but not enough.
Not enough given their capital. I take your point.
Yes.
They're in a specific situation. Okay, I'm running out of time, so I will have to put the entire banking picture in front of you. We now have all the top 5 or 6 banks. You also, I think, additionally cover AU and Federal. So now what is your hierarchy of picks? And why?
HDFC, ICICI, Axis has been our top 3 picks. I mean, HDFC and Axis both have higher upsides than ICICI, but on a risk-adjusted basis, ICICI still remains the best bet through any kind of turbulence within the sector. SBI, we are neutral. Kotak, we have an underperform. IndusInd, given the volatility, we have an underperform. And that's a development we would watch very closely. You know that I have downgraded AU to underperform recently. It was a 2-notch downgrade. Stock has actually done the other way around. But there are some concerns that I have regarding both their long-term compounding outlook as well as the volatility around it, which has led me to moderate valuations. And CUBK also, we have underperformed. But the thing is that for the last 2-3 quarters, numbers seem to be on the mend. Is it enough to change our view yet? Probably not, but we are watching it very closely.
Okay. Well, very quickly, a word on Bajaj Finance. Expensive stock still remains a buy for you?
Yes, definitely. I mean, in the beginning of the year, we had almost 55% upside on the stock. Then the stock did very well. And now, what might be seen as a 100 basis point 1-year growth outlook moderation, stock seems to have corrected quite a bit. So it still remains a healthy opportunity, definitely our best within the NBFC pack, and probably close to a 30% kind of return idea right now.
Yeah, expensive, but then it is at least 25% sustained growth. So, you have to give it a higher value. Shantanu, very quickly, what is your head of research or your strategist's view? Do banks come high in the hierarchy?
Yes, we are still running a small overweight on banks, and it is not as large a overweight as we were running last year, but it's still an overweight nevertheless.
Okay. And very quickly, you wouldn't worry now about asset quality at all? The scare on unsecured is over?
Look, I mean, I'm not. Let's keep MFI to one side of the table.
Yes.
But other than that, I'm not majorly worried about asset quality. Having said that, some of the credit cost numbers in things like SBI look absolutely pristine, have been doing so for all but the current quarter, right? So there's some degree of normalization that can happen, and which we expect to happen even without any major change in asset quality. Quite simply, prudence will call upon these banks to increase their provisioning, which, if you are a 1% ROA business, has significant implications.
Okay. Well, there are a few more questions, but I'll take a rain check from you for another day. We are out of time. But banking results so far have been satisfactory. What we have to check out is who are the banks that are going to gain from the new LCR rules. They will be able to perhaps show higher credit growth, but that discussion on another day. For the moment, wrap up on Bazaar. Chartbusters coming up after the break.